You know, when you hear people talk about a gold rush, I feel like the image that pops into your head is probably always exactly the same.
Right. It's like some lone prospector.
Yeah, knee-deep in a freezing river, just shaking a pan, right? Praying to see a tiny glint of yellow.
Which is actually really funny because, I mean, historically speaking, that was the ultimate high-risk, low-reward gamble. The vast majority of those prospectors, they just went home completely broke.
Exactly. The people who actually made the guaranteed generational fortunes, they weren't standing in the river at all,
No, they were sitting comfortably on the riverbank.
selling the shovels and the boots and the tents. And today, I mean, here in 2026, the river is artificial intelligence.
Right. And the shovels aren't just software packages or microchips anymore.
No, we are talking about physical, heavy-duty industrial infrastructure. We're looking at a market where the old rules of who actually captures the profit are just being completely rewritten.
Yeah, because the initial hype phase is over, right?
Right.
We are now squarely in the deployment phase, and that requires massive tangible capital.
Which brings us to the core of what we are doing today.
Uh,
Welcome back to the Deep Dive, everyone. This is part 2 of our current earnings series.
yeah, in part 1, we covered the pure play tech stocks, so basically the people panning for gold.
Right. But today, we are pivoting. We are looking at a diverse stack of heavy hitters across, well, consumer goods, travel, healthcare, and industrials that just reported their Q2 2026 earnings.
It's quite the lineup.
It is. We are looking at Celsius, Booking Holdings, Monster Beverage, Airbnb, Thermo Fisher, Eli Lilly, and Caterpillar. Our mission is to figure out which of these are actually worth investing in right now based on their future outlooks and, their intrinsic fair prices.
It's a diverse list, but as we are going to see, there is a very specific thread tying their fortunes together right now.
Definitely. And real quick, before we get into the weeds, I want to give a super brief shout out to RankingStock.com. They provided the proprietary intrinsic fair value models we are using for today's deep dive.
Which are incredibly helpful.
So helpful. They actually have a 7-day free trial right now, so I really encourage you to take advantage of that and run these exact numbers yourself.
Definitely worth checking out.
And just a very brief but firm reminder as we dive in, I'm sharing our analysis to help you learn, but you have to perform your own research before investing. This is not financial advice.
Right. Never just blindly follow what you hear.
Exactly. Okay, let's set the stage. What is the overarching macro theme across all these different sectors in Q3 2026?
Well, the defining characteristic of the market right now is just profound bifurcation. Like the rising tide is no longer lifting all boats.
Right. It's not like 2021 anymore.
Yeah. Exactly. A couple of years ago, if a company showed top-line revenue growth, the stock just went up. But that isn't enough anymore. What matters today is the durability of a company's economic moat, and crucially, how agile they are with their physical supply chains.
Okay, so we are moving from a world of, growth at all costs to a world of operational efficiency at all costs.
Precisely.
Let's test that theory then. Let's look at the physical picks and shovels powering this AI revolution. Because when I say AI, the absolute last company you probably think of is Caterpillar.
Which is exactly why the market has been totally mispricing them. I mean, Caterpillar just posted a historic second quarter.
Historic in what way?
They did $20.54 billion in revenue in a single quarter.
Wait, 20.5 billion? For a company most people associate with, those yellow dump trucks on the side of the highway.
Yeah, exactly.
So how does a heavy machinery company become a massive AI play?
You have to look at a power grid. So tech companies are currently racing to build these hyperscale data centers to process generative AI, right?
Right, the huge server farms.
Yeah. And a single one of these facilities can require 100 megawatts of power. The problem is that local utility grids literally cannot handle that kind of localized massive load.
The grid would just melt.
Basically, yeah. And getting permits to build new municipal power lines takes years.
And obviously, tech companies do not have years to wait.
Exactly. So what do? These mega cap tech companies are just completely bypassing the local utilities. They are going directly to Caterpillar and buying massive reciprocating engines and industrial gas turbines to generate their own power on site.
Oh, wow.
Yeah, Caterpillar's power and energy sales jumped 17% in the quarter for this exact reason.
They are literally selling the power plants for the AI gold rush. That is brilliant. But let me push back on the stock itself for a second.
Sure. Yeah.
Their order backlog just hit $72 billion, extending all the way into 2030. Which sounds amazing.
It is amazing.
But the stock is trading around, what, $854.60 a share? Isn't it just way too expensive for a heavy machinery company?
Well, under Under normal circumstances, you'd be absolutely right to be cautious. But the intrinsic fair value model actually prices them right around $853.82.
So it's basically perfectly fairly valued.
Exactly. And the reason it's justified is because the business model has been fundamentally de-risked. That $72 billion backlog isn't for, speculative condo developments. It's for essential tech infrastructure. They are no longer subject to those same short-term economic boom and bust cycles.
So they basically transformed from a cyclical construction play into like a predictable tech utility.
Yes, that's exactly it. So the investment verdict here is a strong buy with a target of $950 by mid-2027.
That is fascinating. Okay, now, if Caterpillar is building the physical infrastructure, let's look at the research infrastructure in healthcare. Thermo Fisher Scientific. They just posted $11.99 billion in Q2 revenue.
Which was just a massive sigh of relief for the entire healthcare sector, to be honest.
Why is that?
Because it proves that biotech funding is actually recovering. It had really dried up over the last year or so.
Right, but Thermo Fisher isn't just selling basic lab equipment anymore. They are integrating AI into their physical hardware now, right?
Yeah, and this is how you build an impregnable economic moat. They have these Orbitrap mass spectrometers, and they use embedded AI to exponentially accelerate biological research.
Okay.
But the genius isn't just the speed. By embedding the AI into the physical hardware, the machine learns the specific workflows of the lab it's in.
Oh, I see. It's an ecosystem play. It's kind of like how Apple keeps you locked into the iPhone, because leaving means losing all your connected data and seamless syncing.
Precisely. If a pharmaceutical company wants to switch away from Thermo Fisher's equipment to a competitor, the switching costs are astronomically high. They lose all that localized AI training.
So Thermo Fisher is executing a brilliant lock-in strategy. The revenue's recovering, the execution is flawless. Does that make the stock a buy today?
Actually, no. The verdict right now is a hold.
Really? What?
They are trading around $595.89, which is a 3.5% premium to their fair value of $575.79.
Ah, I see.
Yeah, you have to separate a flawless company from a flawless entry price. The market has already priced in the recovery. It's best to hold and wait for a market correction to get a better price.
That makes total sense. Okay, let's shift gears. Because building great products, whether it's a gas turbine or a mass spectrometer, that is really only half the battle.
Oh, absolutely.
Getting those physical products to consumers without crushing your profit margins is the real test of agility right now. Let's talk about Celsius Holdings.
This is perhaps the most fascinating case study in market overreaction we've seen all year.
Okay, let's unpack this. Because to a casual observer, Celsius looks like a complete disaster.
It really does.
The stock collapsed 49% over the trailing year. Their core Celsius brand revenue dropped 11.7%. If I'm an investor looking at a stock that dropped 49%, isn't this just a falling knife? Why would anyone buy this?
Because that revenue drop, it's a complete supply chain illusion.
Wait, what do you mean by an illusion? Like, the numbers are the numbers, right?
You have to look at where the numbers are coming from. If you look at actual consumer scanner data, meaning the physical cans being bought at cash registers, demand only dipped 2%.
Really? So if consumers are still buying it, why did the company's revenue drop almost 12%?
It came from a massive destocking event by PepsiCo. PepsiCo is their distributor, and they realized they had way too much inventory in their own warehouses. So they basically just stopped ordering new pallets from Celsius until they burned through what they had.
Wow. So it's purely a warehouse logistics issue, not a consumer demands issue.
Exactly. And on top of that, their other brand, Alani Nu, actually saw sales surge 21%.
So the underlying business is totally healthy. The market just punished them for a temporary supply chain glitch.
Yes. So the investment verdict here is a buy. It's trading at $28.78, which is a massive 31.6% discount to its fair value of $42.10.
That is a huge discount.
It is. And management is bringing a new North Carolina plant online to fix these margin pressures. It is a premier value buy right now.
Okay, let's contrast Celsius with another beverage giant, Monster Beverage.
Right.
They just did a 2-for-1 stock split. Q2 sales topped $2.5 billion. International sales skyrocketed 34.6%.
It sounds phenomenal on paper.
But the problem is, despite this huge international growth, Monster is getting totally squeezed by aluminum costs and freight. What is going on there?
They're suffering from the margin dilution paradox.
Margin dilution paradox. Explain that.
Selling energy drinks overseas brings in massive absolute dollars, right?
Yeah.
But it comes at a much lower margin percentage than domestic sales. You have high shipping costs, tariffs, expensive aluminum. So selling overseas brings in more cash, but it dilutes their overall profit margin.
I get it. So what's the verdict on Monster?
Well, so it's trading at $46.68, which is a tiny 1.3% premium to fair value. You really want to wait for their Q4 domestic price hikes to take effect before buying in.
Hold the line on Monster. Got it. Now, if Monster is struggling with margins, let's talk about Eli Lilly, because their margins are just insane.
Unbelievable margin.
Explosive 48% revenue growth to $22.97 billion, driven by GLP-1 drugs like Mounjaro and Zepbound. And their gross margins hit 86.3%.
Yeah, it's just staggering.
I mean, Lilly's strategic moat is like a fortress. They have a new drug, retatrutide, showing 20% weight loss. And they are proactively building massive plants in Ireland and Indiana.
Right, they are avoiding the supply bottlenecks that trapped others. By building their own plants, they control their own destiny.
But, and this is a big but, the stock is trading at $1,209 with a PE ratio of 40. For a pharma company, that's terrifying. Is it a buy at that price?
Surprisingly, yes. The verdict is a buy.
Really? At a 40 multiple?
Yes, because it's trading right at its fair value of $1,210. Even with that high PE, they are growing into it with over 30% forward revenue growth. They have a target of $1,350 by mid-2027.
So they're just outrunning their own expensive valuation. That's incredible. Okay, here's where it gets really interesting. Let's pivot to consumer discretionary spending. Travel shows a massive split in how people are spending their money right now.
A total bifurcation.
Let's start with Booking Holdings. They did a 25-for-1 stock split. Massive 49.5% free cash flow margin. But air travel is clearly decelerating due to high fares.
That's the big macro issue for them.
And on top of that, they are spending a fortune on marketing right now to fight off AI search engine overviews.
Right, because Google's AI is trying to answer travel queries directly so people don't click through to Booking.com. It's forcing them to spend heavily to acquire customers.
So what's the verdict?
Hold. They are trading at $213.34, which is about a 3% premium to fair value. The market has already efficiently priced in their new $650 million AI cost-saving transformation.
Okay, so wait for a dip.
Yeah, wait for a macro pullback below $195.
No, let's look at the other traveler, Airbnb. They had a stellar Q2. Revenue up 17% to $3.61 billion. They're using AI to reduce support costs by 16%.
Sounds great, right?
It does. But here is the glaring contradiction. Business is supposedly booming, but CEO Brian Chesky and other insiders are selling stock. Why would they do that if things are so great?
Because there's a structural flaw hiding in their numbers. It's this new feature called Reserve Now, Pay Later.
Oh, I've seen that on the app. How does that affect the stock?
Well, it is juicing their total bookings. It makes their top-line growth look fantastic.
Right.
But it's causing their actual take rate, which is their profit margin on those bookings, to stay completely flat for the rest of 2026 because they aren't collecting the cash up front anymore.
Ah, so the growth is basically hollow.
Exactly. So the investment verdict here is sell or take profits if you own it.
So get out now.
Yeah. At $185.13, it trades at a massive 24.1% premium to its fair value of $149.13. You really want to take profits before that flat take rate reality hits the stock price later this year.
Got it. Okay, let's synthesize all of this so we have a clear map forward.
Let's do it.
If you were looking for value, buy the over-punished supply chain glitch, which is Celsius.
Yeah.
Anchor your portfolio with the undeniable AI and healthcare supercycles. That's Caterpillar and Eli Lilly.
Spot on.
Take profits on overpriced travel platforms like Airbnb. And then hold the steady compounders. Monster, Booking Holdings, and Thermo Fisher until the price is right.
That is a perfect summary.
Awesome. Now, before we sign off, I know you always have one larger concept for us to chew on. What's your final thought for today?
It goes back to that Caterpillar data. If major tech companies are now being forced to bypass local utility grids, right, and buy their own massive gas turbines just to keep their AI servers running,
Yeah.
are we entering an era where corporations effectively have to become their own municipal power providers? just to survive.
Wow.
I mean, think about it. If tech giants start controlling not just our data, but massive independent chunks of the power grid, that changes the fundamental structure of our economy.
That is wild. I mean, that
Yeah.
is definitely something that will keep you up at night.
For sure.
I really want to hear what you guys think about that and about all 7 of the stocks we cover today. Seriously, leave a comment down below with your thoughts on this earnings season. And hey, if you found this deep dive valuable, do me a huge favor, hit that subscribe button and click the bell icon.
It really helps.
It is the absolute best way to support this YouTube channel, and it ensures you never miss out on these analyses because as we saw today, the surface numbers almost never tell the real story.
Absolutely. Always look under the hood.
Thanks for joining us on this deep dive. See you in the next one.